This is the industrial side. Most industrial businesses are either won or lost in the day-to-day operations. These are conversations with the operators who run these firms, talking about how they run them, what works, and what doesn't.
Ryan Kirby, partner at Alderman Company. How are you doing today, sir?
I'm doing very well, Brian. Thank you. Good morning to you and good afternoon from me.
And you're coming from the UK.
I am. So dialing in from the UK, based in Florida, and I do consider myself a Floridian these days, but I'm calling in from the UK, yes, and I will be at the Farnborough Air Show here in the UK as well next month. So I'm doing well. How you doing?
I'm doing pretty good, man. I mean, I think listening to feedback from some of the listeners of the show, we need more accents. So I decided that I had to find someone, and you were the perfect person to bring on to bring a little bit more of the European swagger onto the show.
Yeah, my wife keeps telling me off because I sound more and more American every day. So we try to get back to the UK to refresh my accent and make me sound more English again. So she's happy.
Yeah, you can't get overexposure down here. It'll turn like this. Well, good. We've talked a lot in my time looking at buying businesses. We ran into each other because you represent sellers. You help them, your M&A advisor, investment bank. I don't know what the title you like to call yourself, but you essentially help business owners sell their companies for basically the best situation for them, whether that means the highest price, the best buyer, the best situation. And so you kind of represent the sellers. So this will be an interesting episode because we've been talking to a lot of people running companies. I think a lot of people are on the process of selling their companies and they just don't know where to start. So I think I want to pick your brain a little bit about what are people supposed to be doing right now?
Yeah, it is truly a minefield. The sale process in general there's a lot that can go wrong. And often people will say, hey, just like you would sell your house. And a lot of the similar process elements, valuation tools and metrics and things, just like selling your house, it's pretty similar for a business. However, there's exponentially more potential issues that can go wrong. There's just a whole number of different things, whether it be your financial and accounting systems or whether it be, a succession plan for management, right? I mean, the list is endless and I'm looking forward to diving into some of these things, especially for the listeners who are those business owners. We will take a deep dive here into what is some of the things that we see time and time again that you can relatively easily correct and you will be significantly more valuable in the future as well. So we love what we do. We do have an aerospace and defense focus. That's the end market that we focus in, and we're probably aerospace and defense people first, and then bankers second almost. We all have industry experience of different sorts and things, but we love aerospace and defense, and we love helping those who are thinking about whether they have 50%, 40% or more of their end markets are in aerospace and defense, their customer base. We would help them through the sale process and be their broker, be their banker, in order to get them ready, get them in the right conversations, match make with the right potential buyers, and get them either the best value or the best fit or whatever it may be. Like you said, everybody's got different preferences, and we've had clients over the past that they get to a point where they love the price, and it just gets to a point of, hey, we just want to pick the right person to carry on the legacy or look after my people, right? I mean, the majority of our clients are family-owned, operated businesses, and they would like to have somebody come in, give them a great price for their business, but then look after it and continue the legacy and look after their people, right? So that's one of the other key things that we see when it's coming to the point of selecting a potential buyer. But happy to talk about the sale process overall, educate as much as possible, or happy to talk about anything aerospace or defense, or anything about actual preparation and those key items that we see time and time again. Happy to dive into all that stuff. That sounds great.
Yeah, I mean, with my background, I was in the military as a aircraft mechanic. I thought aerospace and defense would be pretty interesting as an area to look at, just given, the scope of what's going on in the world right now. I mean, there's, for the different suppliers that support that supply chain, that's growing in the right direction, and it's kind of critical, mission critical. Kind of like the definition of mission critical. So it's very interesting. But a lot of the companies I talked to, I'd find myself even more disappointed than the owners on some of the issues that came up, whether it be the owner is central to selling anything ever, or there's customer concentration, or there's no go-to-market process whatsoever. It's just kind of bid on the 4 or 5 projects that come out from the relationship. So there's this dichotomy. I mean, I think there's really no downside of customer concentration in a lot of ways when you're running a business, because then you just got to treat like 5 customers really well versus having to try to like somehow figure out in your mind how to treat 1,000 customers really well. But when you're trying to buy a company, like the relationship equity is essentially gone the second the company's sold. So you kind of see things differently. Like, do you run into that a lot with A&D acquisitions?
Yeah, so we see it all the time. You talked about customer concentration. So a lot of the companies we work with are family-owned operated businesses. We had a sale in our past that, and I'm going to try and give as many real-world case study examples and scenarios, and obviously no names and no detail because
Right.
they're our clients and we wouldn't do that. But I'm going to try and give some real-world stuff that isn't just super high level and not super helpful. So we had a client in the past that they had 90+% concentration with one customer. Large defense prime, everyday name. And one of the things that we found with them was how do we market that? That's a difficult sale. Like that's not a traditional, hey, you have a diversified customer base, which is usually preferred by a potential buyer. And why is that? Because it's a better risk profile for them, right? If you just have 5 customers, well, if you lose 2 of them, then that's 40% of your business gone, right? So they're always going to look at this, and the potential buyer universe that we speak to every day are very logical, very smart people, and they're going to say, hey, maybe you have this customer concentration issue and we'll discount because of risk accordingly, right? So I will say that, and I say in general, yes, diversification is better than not, right? Yeah, great. It's also easy to say, just diversify, get more customers, right? Well, that's not really very helpful. So what we find is one of the great things that you can do with these large primes is you've got a family-owned operated business. They've got a couple of big contracts. They may be near their large customer physically. Maybe that's why they set it up, or maybe they were an employee of this prime and then they started their own thing, and they're now a part of the supply chain. Maybe they identified an issue or something like that, and that they have seen something that they can start a business with. We see that time and time again. We've worked with that a lot in the past. And then it's hard because you've got a great customer, you keep growing with that customer, and you can maybe you add some more capabilities, or maybe you get onto different programs with that one customer. So when there's customer concentration, you've got to try and find different ways in which you've diversified. So we said that, hey, maybe they have 91% of their revenue going to this large prime. But when you break it down by program level, they're actually going to 7 different major programs within this prime. So that's one of the ways you can position a company that has concentration risk, is you shift the conversation and say, well, yes, it's a one customer, and you clearly state that in the marketing materials. You don't hide anything, but then you say, yes, but look at all these different ways in which they are diversified. They're actually going to these 7 different major programs that are all quite different, actually. So that's one of the things we see. We see all the time. You have a great customer, you grow, you keep growing with that one, and then you get to the point of a sale and you say, oh, hang on, actually, there's going to be a bit of a discount because of the concentration. So yeah, I mean, that's one of the real world examples of addressing that, right?
Yeah, and we should dig on that because it's and let me speak as a buyer. Like almost any company, like basically when they're first getting traction, probably builds off of one big customer, and like you can maybe get pretty far with that customer if they have a lot of needs, and so that actually makes your operation a lot simpler. There's no lack of intelligence in building your company around specific core sets of customers. It's just that there's so much in terms of relationship, in terms of just things that would be totally different for a new owner of the company, to where that like you could just basically a huge chunk of the revenue could just walk away the second that we acquire the company. So like it comes out as more of like some buyers are not really approaching sellers the right way. They're like, how could you have so much customer concentration? Don't you know this is a problem? But to be honest, a lot of founder-led, owner-led companies, when they have huge customer concentration, that customer loves them, and it makes the whole operation easier because they have to focus on a smaller subset of customers than if they were to have 1,000, 2,000, 5,000 customers. and try to somehow replicate the customer service they're delivering to all those other people. So it's not so obvious. Like, I think from a buyer, it's obvious that like there's risk there. For a seller, it's not so obvious because it kind of sounds like bullshit, to be honest.
Yep.
Because like, especially you get a customer for 10 years, you think like they're just gonna leave the first day. But honestly, that happens a lot when there's these transactions because they don't know if they can trust the new owner as much as the old one. So it's kind of a delicate thing.
Let's lead on from that. So the next element is succession planning, right? So we talked about customer concentration. That's one of the key items that needs to be addressed and positioned correctly when you're going to the marketplace. Let's talk about succession planning. So what we've seen successfully over the past 25 years, we had our 25th anniversary 2 months ago.
Congratulations.
Thank you. Yeah, Bill Alderman was the founding partner of our firm and does an excellent job of building it and focusing it around A&D people who love what they do. So he's done a fantastic job. I think on the succession planning, what we've seen over the past 25 years is the best way to do it is a few years out, 5 years out, whatever it may be. If you would like to retire, so all this depends on your situation. If you have built your business and you would like to retire, which is primarily our client base.
Mm-hmm.
It's typically the at the end of the marketing materials you have, or at the start, sale rationale.
Yeah.
It's typically the owner wants to retire. That's what we do the most of. That's a large portion of our book of business. When that's the case, you want to try and build a company that can run without you, doesn't rely on you anymore. Because if you want to retire, well, then you won't be with the business anymore post-sale. So you need to have the company operating that way before you leave, right? So that's the dream scenario. That's the best way, where a few years out, you've trained, you've passed on some of these relationships to an excellent general manager that you have, or a president, a VP, a COO, a CFO, whomever it may be, that would be the next person to take over. That's the best way to prepare for a sale ahead of time. It's difficult, it's uncomfortable, but the best way if you want to retire is to basically retire before you sell the company. I mean, that is what I'd say time and time again. If you want to roll equity, right? If you're a seller and you say, hey, I want to roll 20% equity, I want to have another bite at the apple later down the line, I want to remain a part of this business, well, then you don't need to do that, right? Because if you want to just gain have a majority sale at 80% of your business to a great institutional buyer, and you want to grow with a new institutional partner and majority owner, now you're working for someone else, which is a tough relationship that owner operators who've previously they were their own boss, now they have a boss again, right? And that's typically they stabbed their own thing because they didn't want a boss. But if you're going to roll equity, you don't need to do that as much, right? Because you're still going to be a part of it. So succession planning is a wonderful topic, and for every different scenario, there's a different solution. But super high level, if you want to retire, try to get the business in a place where you can essentially retire before so. And then if you want to roll some equity, then hey, be a great part of the company and keep with it. That's great. And then there's all sorts of different scenarios, and I dive into more, but there's a lot of stuff we want to cover. But that's some of the stuff I see in the succession planning. Yeah.
Yeah, and like there's a logical component of it in terms of like the best time to sell is when you don't need to sell because you can be selective. But it gets harder because I think a lot of the business owners I talk to, they know they could maybe try to make some big hires. They could try to hire a GM. They could try to hire a CEO, even a COO. They could try to hire people that can operationally run the business, but then they're afraid of the risk of that individual not working out. And they know that like because of all their 20, 30, 40 years of experience, they can produce 1 to 5 billion of EBITDA, just kind of keeping their hand on the wheel a little bit. And so it's kind of like there's almost this dream of not taking the risk in building the team and then just finding a buyer to appreciate how good the company is that will then go build the team. Why doesn't that work?
Yeah, we've seen success all over the place. So we've seen success from individuals hiring externally. There's a lot of great search firms in aerospace and defense that are absolutely marvelous. And they find the right person, go out, headhunt the right person, and they can be the succession plan. We've also seen probably a bit more often than what I just mentioned is growing someone within, right? Somebody who's been with the company 10, 15 years, or, pick your favorite amount of time with the business, and they naturally just grow through the business, have worked on the shop floor, they work their way through, now they're a manager of whatever it may be, whatever sector, and then part of the business, and then they go and go that way. We've seen tons of success there as well. So, and it also depends on the buyer, right? I mean, if you have a strategic buyer, sometimes they have individuals who are going to be leading the business anyway, so they don't necessarily need a next, number one, a next CEO. They don't need it because they're going to take you in and you're going to be part of that bigger system. Some individuals, some of the smaller potential buyers, those that are, kind of an independent sponsor, they want to be the CEO themselves, right? So they want to buy the company, they run it themselves. So, I mean, all this stuff is, to talk about in generality is it's not super helpful sometimes because it's case by case, but I mean, we've seen success all over the place and we've seen difficulties all over the place. It's just you got to pick your scenario and plan accordingly.
So go further a little bit, like in terms of the types of buyers. I'm familiar with some of these terms for the audience. Like difference between a strategic buyer, financial buyer. Kind of go into like if I'm trying to sell my business. Let's say I'm running an aerospace and defense electronic components company. I manufacture them, I sell them to the military or to subcontractors of the military, and now I'm looking to sell. Who could buy my company?
Yeah, great question. So first off, I think I'm gonna try and go in order of most commonly will pay the least, all the way up until most commonly will pay the most. Okay, so I'll start low and I'll work my way up. And again, my caveat is this all depends on the scenario. This is just a broad statement. So there's individuals they called independent sponsors or individuals they're looking for a company to buy and they're looking to run that company. So those are the individuals who typically they'll look at an acquisition and think, what can I afford in terms of financing this and basically paying down my debt if they've taken out debt to make the acquisition. What can we afford to pay and what can I get by month? So that's an individual. There's a lot of great people out there, right? They've had great careers and then they want to own their own thing and they don't want to start their own thing. They just want to buy it. Okay. So that's a group. They call them typically independent sponsors and typically they aren't able to pay the most because it's a small one or group of individuals. They don't have institutional backing and they often have to make the acquisition through a high amount of debt. So they take out debt to make the acquisition. Okay. They typically pay on the lower end, but there's some magnificent individuals and everybody starts somewhere, right? So it's certainly a pool that exists. They are high level you'll hear two main things, financial buyers and strategic buyers. They're in the financial buyer side of the house. Also in the financial buyer side of the house are the institutional buyers. So those are private equity firms, those are family offices and individuals who it's a firm that's set up and they're ready and they typically have committed capital. So they go out, raise a load of money from an investor base, and then they're part of a fund, and then they go and make acquisitions out of that fund. So typically that's classified as a financial buyer because they're making an acquisition. Typically they make a platform. So they make a large acquisition in a new market that they have fundraised around and all the investors are on board with that market. And then they make that acquisition, and then typically they'll make more acquisitions in a roll-up strategy, and then they'll sell it in the future after they've been paying down some of the debt. In the meantime, and then also made a lot of money, and then they can sell for a higher price because they've made a bigger and better business, right? So that's in the financial pool. Where things get a bit confused is that financial buyer of a private equity firm can also be a strategic buyer if they have a business that is similar to yours. So that's typically an excellent potential buyer that we go to relatively often. And obviously the client would approve everybody that you would go to in a potential buyer list. You'd have a conversation with your client and we've had clients in the past who say, I don't want to go to any private equity firms. We try and educate. Why? Maybe that's actually not within your best interest, but if that's your stance, we'll work with you, and that's okay. So it's client by client, a client-focused way there.
Well, let's dive into that a little bit because, like, what I'm hearing with that, especially private equity firm financial buyer profile, it's a flip situation. So you're selling to someone who wants to sell again. So if I've run my company for 30 years you're looking to find succession. You actually haven't found succession. You're selling to someone who's going to then try to sell to someone else. You don't have control over who eventually owns the company. Like what are the, I guess like that seems like a risk to me, but like what's the benefit of that, and like what are the risks with that?
Yeah, I mean, there's the conversation of private equity is a fascinating one, and we've seen clients who love, hate, and are indifferent and all the way in between. Some of the main benefits of private equity and what we try and educate our clients on, that they are an M&A machine, so they will get a transaction done typically very efficiently. So they know what they're doing, they do it day in, day out, and they are built for this purpose. Secondly, there's a lot of amazing individuals in private equity. You know, that there's a lot of operational folks who've been there in your market. So a lot of, again, aerospace and defense professionals who've had amazing careers, and then they want to be a part of the buy, build, and grow the thing and be a part of the private equity world. They also do tend to pay good prices. That's one of the other key items. And we'll get on to strategics in just a moment, but they do pay good prices, and typically they can be a strategic as well because they own something that's similar to yours. So they're actually, typically they own a competitor or a customer or a supplier or whatever it may be. And that's great itself. There are some family offices and things that actually buy and want to hold it forever. They don't have any plan of flipping. But yes, you're right. I mean, the majority of private equity do flip that. So, I mean, hey, there's a lot of downside as well. There's a lot of upside. And our job as a sell side advisor is talking to our clients, understanding what their targets and achieve, what their goals are, and hopefully putting together a sale process in which you have a lot of potential buyers that are interested throughout the auction process. So you as a seller can pick, who do you think is going to be the best firm or individual to take over the business and do right by your people. So I think that's the key. Is it's a conversation with your client, the business owner, to understand their goals and objectives. And hey, every potential buying group has pros and cons. 100%. That's true. And I'll go into strategic very, very quickly here, but strategics often pay great prices. They're typically the individuals that you compete with day to day. Sometimes they're your customers, sometimes they're your suppliers. Sometimes a strategic buyer can be a business that's doing something similar to you, but maybe they're in a different market, right? And they're looking to grow that. Sometimes it's a company that's doing the same thing, but they're looking to grow into your geography, right? So we sold a company earlier this year in the MRO space, and it was a great acquisition, and it grew the business so that they had a US presence. And previously they didn't have a US presence. So that's another, excellent strategic move that we see quite often as well. And I always say, right on the other end of the scale, the highest end of the scale, typically you have strategics that are public companies that are trading at a really amazing multiple at the time. The thing that's really nice about public companies are they can make an acquisition, and as long as it is less than what they are trading at currently in their stock price, then it's called accretive, right? So you're paying less money on a multiples basis to gain the same amount of revenue and EBITDA that you have. EBITDA and revenue is revenue and EBITDA, but you're growing that by making an acquisition at a cheaper price than what you're trading at in the public markets. So typically a great strategic public buyer or one with a close fit competitor or something is the best buyer. And we typically say at Alderman and Company, the best way to get the best price is through fear. So if you can create an environment in which you have a potential buyer that is scared of not having you a part of their business, then you will get the best price and the best outcome that you want. Because fear, time and time again, we've seen pays higher prices than just wanting more or just liking a business.
And how do you create fear in a situation like that?
You create fear by saying, look at this business. If your competitor gets this business, then they are going to be significantly better and competing against you better because they made this acquisition and you did not. And often this is pretty unfiltered, I guess, and quite honest, but and a lot of the time it's I will be scared because I will lose my job if I don't make this acquisition. I mean, that's you talk about going at the human level and the real level here of acquisitions. The best thing we've seen is if an individual feels like, if my competitor buys this, I'm going to get fired because I lost this deal. That's what we've seen time and time again is the way you can have the best outcome as the seller because you've created that environment. Now, does that happen every time? No. Are there amazing acquisitions that happen where that exact scenario isn't the case? Yeah, of course. We've got great acquisitions all over the place for all different reasons. But that's what we try and create when we're positioning a business. How can we make it seem that to the best potential buyers, how would you be devastated and scared to lose it?
Yeah. So that's the demand side. I guess on the supply side, sellers are pretty particular. Like I would imagine, I'm running an MRO supply company. I'm having my own opinions about what the best outcome is. It'd probably be best for you if I was just like, I want the highest number. Or if I was just like, I want somebody in this industry that's going to understand how this company runs and not be a detractor to how the company runs. But usually it's a combination of all of it. They just want everything. So
No,
how do you coach a client in that situation?
Yeah, so one of the it's a great question. One of the first things we do before we get hired, and this is what we do, and this is what everyone in our space does. I mean, this is nothing new, but what's really important is to set expectations. So the first thing we do when we are talking to a middle market aerospace and defense business owner is we say, this is what we think your company's worth. And here's why. And here's all our models. We have many different models that all triangulate to a value. And we love talking about that. But this is what we think the market is going to pay you. And is that aligned with your expectations? And sometimes the client says, no, that's nowhere near what we thought. And we say, okay, are you willing to wait? No. Okay. Then maybe we don't work together, right? And maybe a different investment banker can see a different story or something. I don't know. But aligning expectations early on in the process is really important. And a lot of the time, what we try and say to the seller, the business owner is, this is what we believe, but actually not really. This is what we're seeing in the marketplace and what the potential buyers are willing to bear. Right. So a lot of the time it's actually educating on what the marketplace is saying, not necessarily what we're saying. Right. We're kind of a voice piece for the marketplace at times. And that's what, a good intermediary like we try and do. We've worked with clients from all ranges of, political beliefs to value expectation beliefs to different geographies to we've done the whole scope. And one of the things that we try and get a grasp on is how aware are you of the M&A process? Because that really centers how much education we do before we start diving into each step of the process, right? If you have an individual who's sold and bought companies before, and this is another company that they're going to sell, then we will have to do a little bit less educating than if this is the first time you've been through the sale process and you don't know how it works. So I'd say really importantly, first off, we align expectations on roughly this is what we think value is, and we think this is what the market's going to bear. Do you agree? Let's have a conversation about it. And secondly, as we've worked with a whole range of different individuals, and we've found time and time again, it's understanding what education we need to do to get our client ready to go through the process. Because like we said at the start, this is a complicated process where a lot of things can go wrong and you need to know what you're in for and what's in store for you throughout. So education is a huge part of our job. And I also love it as well. I love talking about this and educating as well. But yeah, I'd say that those are two really important things.
In terms of expectations, I would assume, you don't have to give specific numbers, but I would assume that the more you sell business for, the more money you as a company make. Is that right?
Yeah, typically in our industry, it's commission-based. So it will be a couple of retainers and everybody structures those differently. But primarily an intermediary, an investment banker will have a percentage that when you sell your business, typically you get X percentage. And yes, a higher price will pretty much always result in a higher outcome, a higher commission for the banker, right? And we always say you should align yourselves in the same way. You will behave how you are financially incentivized to behave. So you have to put together an engagement agreement with your banker that aligns you with your outcomes. And pretty much always it's, hey, a better price, we get paid more money. Great. And we're all happy. So that's what we try and create. try and create an environment where our client's super happy, they got a great price. And yeah, if we get a great price, we'll be compensated alongside you, right? We want to be on the same side of the table. That's pretty much how every banker in the industry positions it. Yeah.
Yeah. And so what's interesting is like when I run into a seller that's thinking their number is like 10 times EBITDA, but realistically it would be 6 to 7 times EBITDA. And so I imagine when they went through the process of picking their advisors, they heard a bunch of people telling them, no, it's 6 to 7 times. And then somebody said we could sell it for whatever you want. Why does that happen?
And then do they sell it for whatever they want? Probably
No,
not.
no.
So I mean, we're the same. We're maybe to a fault at times. We're a super straightforward, simple shooter, honest firm. We align expectations super early on, and does that mean we miss out on some opportunities? Maybe. But what we say we can deliver, we deliver. You know, we deliver exactly what we promise. There's always folks out there in the banking industry that will just say whatever they can to get hired. And unfortunately, that's just always going to happen. You know, if you think about it in a manufacturing, you know, you're bidding on work. Sometimes it just goes to the lowest bidder or the one that, you know, says, hey, we can deliver the most. Doesn't mean they're going to.
Yeah.
But sometimes that's just how the bid is won. Right. So
let's play devil's advocate on that though. Like, because I'm a seller. Let's say my time horizon is maybe 5 years instead of 1 year. What's the problem with just like going with whoever said they could figure out how to sell it for 10 times? If they can't sell it, then I could maybe circle back to the other people that said it was 6 to 7 times. Like, what's the cost?
Yeah, I mean, typically there's an engagement agreement that you set up with your banker, and it will have a term. So, and then typically it has a tail as well. So you have a term of X amount of time, and that's when you are exclusive with that banker. It's only that banker can represent you. And then there'll typically be a tail as well. So after you've ended your engagement with them, there'll be X period of time where, again, you can only, if you have a successful sale, then the banker gets paid that commission, even though they're not actively engaged. So a lot of it is the banker you hire. We've had deals recently. We actually a couple this year where it was a different banker was hired, went through the process, weren't successful. They waited a year or two. They went back, looked for another banker, hired us, and then we got it done. So that does happen, Brian. It does. But typically we say go for a banker that you trust, you seem to resonate with, and see where it takes you. But I always think it's important that during the selection of the banker process, you go with someone that you feel like you can trust.
Yeah. I mean, I think some people think of it more similar to real estate, or like maybe they don't want to sell their house necessarily, but like someone can make an offer they can't refuse. So like, why don't I just put it on Zillow and like see what comes out? But I think what ends up happening is there's a lot more demands of a buyer than of a business than a house, and so there'll be diligence requests. There'll be all kinds of things that require effort, and that effort may only be worth it if it's possible for you to get to a valuation that both sides can agree on.
Right. Yeah, and to respond to the comment about the Zillow listing, the thing about your house is you don't have, 20, 30, 100, 200 people working at your house, right? And have it as a livelihood, right? So that's one of the key things is the employees typically do get a little scared, or maybe just they don't like the uncertainty, right? Which a transition of ownership brings, which is completely understandable. So that's the other key thing is you don't go to the universe, you don't tell everybody, and you don't put an open listing up out there because of many reasons, but that's probably one of the key ones we've seen is you don't want all of your people leaving and feeling or feeling like they don't have certainty in their jobs and things as well. So
yeah,
that's one of the key items there.
No, that's helpful. No, that's helpful framing of how this works. I guess just to bring it home as we end here, like just I guess what are you saying today in terms of interest rates have been an issue for buyers over the last 3 years? There's still been a lot of M&A activity, but like have you seen any shift in terms of how active either financial, strategic, or both buyers are being in the M&A market today? And how do you see it changing over the next few years?
Yeah, so aerospace and defense in general it's a very active market right now. We're the busiest we've ever been, and I always say it's hard to tell if we're gaining market share or if we're just a part of a growing market, right? Yeah. And it's always an interesting kind of analysis to do, but we're the busiest we've ever been. Q1 of this year, 2026, was the most A&D transactions on record.
Wow.
And it's on track to continue. I think this year will continue to be a very strong M&A, A&D landscape. Lots of acquisitions, lots of getting done, right? So a lot of people say, oh, it's a seller's market or it's a buyer's market. Well, that doesn't really make sense, because then if it's a seller's market, then nobody's going to be buying, right? So at the moment, valuations are very strong and deals are getting done. So there is a marketplace that's happening. I think this will continue. I think in aerospace and defense, you have space that's doing very, very well, and obviously recent SpaceX IPO and all this stuff, and it's a growing market. Commercial aviation is very strong. Boeing's producing well again. Kelly Ortberg's doing an amazing job so far in turning the business around, and overall commercial aviation's doing well. TSA passenger traffic didn't actually decrease, which I thought was interesting.
Really?
Throughout year to date, and since the war started in Iran, it's actually up from 2025. Not a lot, 0.3% or something, but I thought that was interesting, especially in the environment that we see in commercial aviation with ticket prices rising and things of that nature. We were a little concerned about commercial aviation with rising oil prices, but it's came back down, so that's created some nice stability again. So again, commercial aviation's great. The airlines didn't make a lot of money so far this year, but I think a lot of that is because of oil prices and things, and they've said that they're going to try and keep ticket prices somewhat similar despite their costs coming down, but we will see. But overall, demand in commercial aviation's excellent. Business aviation's doing excellent as well. And defense it's very, very busy right now as well. You know, I won't go into all the detail and everything, but my high level point is all four end markets are doing incredibly well, which is quite unique, honestly, in aerospace and defense. I also say on the flip side, you don't often have all four. I actually would say that there's almost no times in recent history where all four of those sectors have been down as well. So It's actually a great industry for balancing out. You know, you take COVID, well, business aviation was the best it's ever been. It was white hot. Yeah, exactly. You know, the health and wealth effect, right? So, I mean, I think A&D's an excellent space. I think to answer your question specifically, potential buyers in aerospace and defense is super competitive and one of the best environments we've seen in a long time. You've got a lot of sophisticated private equity firms that have great A&D platforms that are aggressively trying to grow. You have a lot of A&D companies that are trading at high multiples that are also looking to grow and keep growing through an acquisition as well. And then you have a lot of individuals who are trying to break into A&D because they see it's a great industry. So I would say now as any is a good time as any to start thinking about, if I have 40 or more % A&D exposure and I'm thinking about a sale in the next even up to 10 years, let's just start thinking about some of the things that you can do every day to start getting your business ready for sale. And an advisor like us that's what we do and we love doing, and helping you get into the marketplace and sell for a great price. So yeah, I'd say interest rates, yes, obviously not quite what it was kind of COVID and pre-COVID times where we had rates that were next to nothing. But the potential buyers that we interact with, all those institutional buyers we interact with day to day, that they have capital ready to deploy and they're deploying it aggressively. I'll give you one interesting statistic. In the Arxis earnings call, so they went public not too long ago, and they're an aerospace and defense focused platform, and they IPO'd. In their earnings call, they said they had a pipeline of 1,500 deals. 1,500.
1,500.
Yeah. Now, obviously, is that everything's lined up and ready to go? No, of course not. But I just thought that was a really interesting statistic where I was like, wow, yeah. There's some amazing firms out there with really sophisticated outreach and pipeline development for acquisitions. So it's fascinating. And it's interesting because we have a lot of individuals that will be looking for advisory work, and then we say, oh, so have you had any inbound inquiries? And they say, here's my folder of the 500 emails I've received over the last year of people trying to buy my business.
Yeah.
So Yeah, I mean it's fascinating stuff. I always recommend don't get rid of all that stuff. Just keep it in a drawer somewhere, print it out, keep it in a drawer, keep a running list somewhere, or put it in an email folder because it's good to keep. Don't just delete that stuff because at some point there's going to be a transition plan. We always say the best way to transition it is typically by passing it down through your family. So obviously that doesn't help us with business, but that's just true. We've seen it time and time again. And you've got to start thinking about these things that you want to prepare for when you go into market because there's a lot to do. We haven't dove into a lot of the specifics around exactly things you should be doing, other than obviously we talked about market customer concentration, we talked about succession planning. Another episode or whatever it may be, we can dive into a whole lot more. I can go real specific in some of those things that we've seen time and time again over the past 25 years that owners, I wouldn't say are doing badly, but just could be doing differently, right, to prepare. Yes.
Yeah, no, that'd be awesome. I mean, you brought a wealth of knowledge here. I'd love to have you on again. If people just, like, based on what you've talked about today, if people want to reach out to you, what would be a good way to do that?
Yeah, certainly. So my email address is probably a good way to reach me, and that's RK, my initials, rk@aldermanco.com. And then also I have my cell available as well, so I'll give that to everybody as well. But my cell is 386-866-4864. And our Alderman and Company website has a contact us page as well. So encourage anybody who wants to learn about M&A, selling your business, aerospace and defense, reach out to either me directly or on our contact us page on our website.
Awesome. I'll put that in the show notes. Thanks again, Ryan. This was awesome.
All right. Thanks very much, Brian. Take care.